Business owners I saw doing well are not necessarily the ones making the most money. They were the ones doing 5 simple things consistently. Now today I'm going to tell you what those things are. Welcome back to The Boring Accountant. This channel is all about taking the boring parts of money, tax, banking and cash flow and turning them into simple practical steps, especially for Kiwis and small business owners. If that sounds useful, consider subscribing so you don't miss out on the next one. Today we're going to be talking about 5 financial habits that most successful business owners I have worked with all share. Habit 1. Separate your personal and business money completely. Different accounts. If you are still running your trade income and your grocery shop money through the same account, your numbers are basically useless. You cannot see if the business is profitable, and for the IRD, you can't easily verify your expenses, and you will also make worse decisions because the picture is blurry. Open a business account today if you don't already have one. Pay yourself a wage or drawings from it, and keep those two worlds miles apart. Habit 2. Set aside money for GST and income tax the moment the money comes in. GST is 15% in New Zealand, and it's not your money, but it can feel like your money right up until the day the return is due. And then every 2 months that bill arrives, and if you've spent the GST, it's a real problem. The fix is simple. Use a separate bank account to sweep 15% of every payment into your account into a separate savers account. Set it up as automatic. Then filling your return is just paperwork. It's never going to be a crisis. Habit 3. Know your numbers. Not obsessively, but know them regularly. Once a month, look at 3 things. Did the business make any money last month? What is outstanding in invoices? And what big expenses are coming up? That's it. You don't need to be an accountant. You just need basic awareness. The clients who make the best decisions are the ones who actually look at their numbers consistently. Habit 4. Plan for provisional tax. This is one that blindsides many small business owners, especially in a good year. Provisional tax is how the ID collects your income tax through the year rather than one lump sum after balance date. If your income jumps, your provisional tax jumps with it. Sometimes that can be significant. For dairy farmers and seasonal businesses, this needs to be actively looked at throughout the year. Talk to your accountant around October or November, not in March, when the estimate is already locked in. A bit of planning here can save you thousands. Habit 5. Have a cash flow forecast, not just a profit figure. Profit and cash are not the same thing. This catches out many business owners. You can have genuinely good year on the books and still hit a cash crunch in the middle of winter. A 90-day rolling forecast, even a simple one, tells you what's coming in and what's going out. It gives you time to act, time to arrange an overdraft before you need it, or time to delay a purchase or bring one forward. That lead time is the difference between managing your finance and reacting to them. So the 5 habits: separate your money, set aside GST, know your numbers, plan for provisional tax and keep an eye on the cash flow. None of these are complicated, they just take consistency. If you're not sure where your business sits on any of these, having a conversation with your accountant before year end, not after. That's what they're here for. If you found this helpful, hit like so more people see it, and subscribe to The Boring Accountant for more simple, practical videos on money, tax and investing. If you've got a question, drop it into the comments below. It might just turn into a future video. Thanks for watching. Till next time.